Hey guys, what's up? I just stumbled across this. Figured maybe you might want to check it out. Either you can go to it or we can go through it together. GMBullion.com has this. How are silver and gold bullion premiums calculated? The price paid for each ounce of bullion is composed of the metal spot price and the bullion premium. Average price composition of common bullion. The American Eagle is 20% premium, 80% spot. Whereas the Canadian Maple Leaf is 16% premium and 84% spot. And the Gold Eagle is 4% premium, 96% spot. How are these bullion premiums determined? How can bullion buyers take advantage of the lowest possible premiums? What's the difference between premium and spot? Obviously, spot price, current price per ounce exchanged on the global commodity markets, where the bullion premium, the additional bullion price charge for a bullion product over its current spot price. The calculation for bullion premiums depends on 5 key factors: the current bullion market supply and demand factors, the volume of bullion offered or bid upon, the bullion seller's objectives, the type of bullion product being sold, local, national, and global economic conditions. Bullion supply and demand. The total amount of supply and demand of bullion is a major influence in bullion's product premiums. Fluctuations in the gold and silver markets affect bullion market supply, and this impacts premium prices. For example, in the Western Hemisphere, during the summer, calmer price patterns mean bullion supply tends to increase. Sellers mark down their prices to attract market share. During other months, silver and gold prices tend to have more volatility. This leads to increasing buying and selling of bullion. Sellers react accordingly. Some may mark up prices to prevent running out of inventory or to capture profits. Bullion dealers are businesses, and they are actively trying to balance product inventory and profitability. Too much inventory is higher costs. Too little inventory equals angry customers. So obviously they have to find that median in the middle. Economic conditions. Depending on their size and significance, market events can affect bullion premiums on either local or even global levels. In a small town with only one brick and mortar coin shop, the dealer may boost their premiums to guard against running out of inventory. In a country like Venezuela, where the local currency is losing value at an extreme rate, locals may opt to buy bullion to preserve their wealth. This means higher premiums. As a global level, in the event of large crisis similar to the 2008 financial crisis, it is likely premiums would increase significantly as demand spikes and supplies diminish, which is what a lot of people are predicting coming up. Volumes being sold. Every seller incurs costs on each transaction, such as time, overhead, and payment processing costs. For a seller, a single transaction for 1 ounce of gold may have similar transaction cost as a 1,000-ounce transaction. Therefore, transactions with higher volumes of bullion have their costs spread out. As a result, premiums tend to be higher on small volume purchases and lower on high volume purchases. Obviously, you know that the more you buy, sometimes the cheaper it is. Form of bullion for sale. As a general rule, the larger the piece of bullion is, the less premium costs are per ounce. It's kind of what we just talked about there. It costs a mint far less to make 100-ounce silver bar versus 100 1-ounce rounds. Now, that's the refiner's problem, I guess, right? But they also should manufacture what it's going to sell. You see coins, rounds, 10-ounce bars, 100-ounce bars. As you go up in size, the cost to manufacture goes down. There is also typically a significant difference in premiums between government and private mint bullion products. For example, the most popular bullion coins in the world is American Silver Eagle and Gold Eagle coins. The U.S. Mint charges a minimum of $2 per ounce over spot for each Silver Eagle and 3% over spot for each Gold Eagle coin they strike and sell at the World Bullion Dealers Market. A private company such as Sunshine Mint will sell their silver rounds and bars in bulk for less than half the premium most government mints will sell their products for. Bullion sellers' objectives. Whether the seller is a large bullion dealer or a private individual, they will almost always want to yield the highest ask price they can get for the bullion they are selling. That said, just because one wants to receive a large premium on the bullion they are selling, that doesn't necessarily mean the market's demand or willing buyers will comply. Obviously, it's only worth what somebody else is willing to pay for it, guys. Dealers must consider these factors when setting premiums: market share objectives, competitor strategies, price equilibrium strategy. If a dealer sets its price too high, buyers will likely choose to go on a lower price competitor. If a dealer sets their price too low, they could end up selling out inventory without gathering enough profit margin to pay for the company's overhead costs. Dealers and sellers are both typically trying to find the price equilibrium, their sweet spot, where the time required to complete the sale is minimized and the seller's profit is maximized. This is more difficult than what it sounds, as it can be thousands of factors at play when establishing the best possible premium to charge in line with one's overall objectives. Spot versus premium: composition of the world's most popular bullion coins. During times of normal bullion demand, here's how much spot prices and premium influence over the overall price of such most popular. You see the silver eagle has the biggest premium here at 20%. The maple leaf is at 16%. RMC silver round, Republic Metals Corporation, is at 7% premium, where the Sunshine 10-ounce silver bar is at 6%, and SJ 100-ounce silver bar is at 5%. For gold, spot prices approximate compromise 95.9% gold bullion's overall price discovery. 4% premium on the American Gold Eagle, 3% on the Canadian Maple Leaf, 2% on a Pamp Suisse 1-ounce bar, and a 1.5% on a Pamp Suisse 1 kilo bar. Obviously, when things get kind of crazy, the premiums can jump. That's crazy, but anyway, I just came across this on JM Bullion, a little bit of information there as we went through it. Rather quick, but definitely head there sometime and check out what it is. I found it at JM Bullion. I'll post a link in the description too. Alright guys, thanks a lot.